Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for April 2nd of 2023. Please see our disclaimer for important information. Hello, everybody, and welcome to the Chart Pack this week. I thought I'd start in a place that has led to some speculation, some questions, a little bit of nervousness in the market. And this has to do with bank deposits fleeing the banking system, as some would have it. And we have clearly seen a drawdown in bank deposits, as you can see here. This is a chart showing the U.S. commercial banking sector, and as it's noted, their biggest drawdown since 2008. So, we don't want to give this short shrift and say, hey, this isn't important. But the backdrop is entirely different. Now, a lot of this is coming out of the small to medium size, like community bank and small regional banks. It's not happening at the large bank level. You're not seeing this at Bank of America. You're not seeing it at JP Morgan Chase, Wells Fargo. In fact, those are the beneficiaries of a lot of this capital flight, if you will. People that in the wake of Silicon Valley and Signature Bank are a little bit more cautious, I guess, about uninsured deposits above the $250,000 FDIC insurance level. A lot of speculation now is being made as whether that should be increased and what's the role of the government in ensuring these things, up to their full amount and whatnot, because that's obviously what turned out to be the case with Silicon Valley. The depositors were made whole. The assets were sold to First Citizens Bank for essentially a song, and there we are. But this is not 2008. We have what's called SIFI, the systemically important financial institutions, and those are some of the ones that I mentioned, J.P. Morgan, et cetera. That cadre, that class of institution. Now, obviously, Silicon Valley was deemed to be systemically important, even if they weren't necessarily on that list prior to. But obviously, the regulators stepped in and said, "Hey, this is going to create a crisis of confidence that we want it to stem." But I don't think we've cleared the smoke here yet on the banking sector, because clearly, as what happened with Silicon Valley, as interest rates rose, all the deposits that were coming in that were being invested in longer dated maturity investments at historically low interest rates, when interest rates rose, those decreased in value at the same time that deposits went out the door. Now, Silicon Valley's problems were very unique. Other banks have a bit of a challenge, but with interest rates having come down a little bit, ironically, in the wake of this, is almost self-serving, because interest rates moving higher is what really put Silicon Valley Bank in a pickle. Now, those rates moving down a little bit actually helps things out a little bit. And we'll see in the next chart, really, that a lot of these bank deposits, if you will, are not necessarily vaporizing. They're just going someplace else. And honestly, they're looking for a higher yield. Banks have, has historically undercut rates relative to market rates, and so you see banks trying to compete for deposits by offering incentive yields on CDs right now. A lot of like teaser rates that won't last, but they'll try to get deposits in the door because on checking accounts, banks are still offering abysmally low rates. And so as we transition to the next slide, what you'll see is they're going into money market mutual funds. And this is the chart that I was mentioning before. And so what we've seen here very clearly is what we call this disintermediation out of the banking sector into the investment sector. And so you see a lot of these deposits leaving bank balance sheets, and they're going into money market mutual funds. And so we can see here in this latest chart, which is maybe a few days dated, but it's out of B of A Global Research, is that they saw about $120 billion of inflows from the prior week. And and this is actually what's going on at Schwab. And Schwab was in the news. There was a journal article last week about some speculation with regard to deposit flight from Schwab's bank, which is a part of Schwab, but obviously their custodial platform, which we're all very intimate with because that's where the investments are being held. But the cash balances for investments go into the Schwab Bank. And the banking system across the spectrum is paying very low interest rates, carrying interest rates on bank deposits right now is still low, very low. In some cases, even 1% when money market mutual funds are paying like 4.6 to 4.7% interest rates right now. And so that's why this money is moving. It's not because people are I think in some cases, perhaps a little concerned about the institution itself, but they're just trying to find a higher and better yield. And this has been a consistent problem with the banks. And it's only really been in the last handful of months that a lot of these banks have kind of awakened from this permafrost, if you will, and said, "Hey, we need to offer a teaser rate on 12-month CDs to try to get these deposits back in." Well, these are teaser rates; they're not necessarily sustainable. But you're obviously seeing a lot of banks try to offer these to either retain deposits or try to attract new deposits. And Schwab is honestly no different. So what we've been doing is trying to take idle balances where we can and actually move them into these money market mutual funds that are paying higher levels of interest. So in many respects, we're actually contributing to the line that you see here, which is really the other side of the ledger from what we saw on that last chart. Now, taking this conversation one step further, I thought it was really interesting to show you this overlay. And so in the blue line, we have the money market total net assets. So this is essentially the same chart that we showed you in the last slide, but it's extended going all the way back to 2007. And that's overlaid with this ratio, if you will, of money market total net assets as a percent of the S&P 500 market cap. So this is a relative analysis here. And so what it shows you is even though we've had this massive near-term spike in money market mutual funds, it really has not moved the needle very much in terms of the relative change in this to the S&P 500 market cap. You can see that in the amber line. It's still about 15%, if you will, so clearly cash balances have gone up, but they're moving away from bank deposits. And in the case of Schwab, they're moving out of kind of like cash that's held in the account that's kind of like swept into the Schwab Bank. It's being held now more so in these money market mutual funds, and so that has continued to move up as a percent of the total. And you can see, looking over a longer time frame here, going back to 2007, you can see, where money market fund assets have spiked, and certainly during the pandemic they went up, but they were already moving higher over the course of 2018 and 2019. But where they are now is extraordinarily high. But again, relative to the size of the overall market, it's not that big. Now let's talk about the stock market for just a little bit. We've got the S&P 500 index forward price to earnings ratio. Again, a sign of valuation in the market. And currently the forward price to earnings ratio is about 18.6. So you can see here at the far right side of this chart that has moved up. It's above the 17.3 median that we have, but it's still clearly within the two bands. So something closer to 13 would obviously be extraordinarily cheap. We haven't seen that since the global financial crisis and its aftermath. And neither is it terribly expensive at 21.4, which we didn't see until earnings cratered during the pandemic. But they're not necessarily cheap. We've seen the value of the market go up. So it's not a bargain here, but it is within a band. And what we see here is really a big reason why the market is moving higher right now. I mean, we're being led by technology, and in a lot of cases, technology stocks and companies that aren't earning that much. So in some respects, we call this a little bit of a junk rally because you've got, underperforming, from a financial standpoint, underperforming companies whose stocks are actually doing relatively well right now at the sake of the dividend payers and the dividend growth companies that you typically want to own when you're in an economic contraction. And so this is a little bit of a counter trend rally that we see in technology right now. And again, you can see that, this sort of thing actually happened a few times. We saw it back in 2020 and during the reopening, and then we clearly saw it in 2021 when the market was largely led by technology. And in fact, it was a very narrow rally. There were actually more stocks in the S&P 500 that actually went down uh, during this various points at the summer of 2021 that actually went up. But the ones that went up so much that it dragged the index, pulled the index higher. And I think in some respects that's happening now because we have seen the earnings contraction. Uh, and we've got some charts on this, and as we'll see in a second, we've had some really strong performance out of some of these indices that are tied directly to technology. But you see the technology price earnings premium here versus the S&P 500 at a level that we have not seen in a very long time. And here we have a quick snippet from the NASDAQ 100. Again, this is a this is a primarily a technology index, very tech intensive, and it has rallied 20% above its interim low, which constitutes a beginning of a new bull market, if you can believe that, in technology. So this is how far and fast these technology stocks have risen in a fairly short period of time. But again, it's a fairly narrow lead right now. And so, if you're in an economic contraction and, we'll look at some liquidity measures that show, I mean, this type of slowdown is on our doorstep. It's clearly evident in some industries, but it doesn't show that, what we don't see right now is just like the economy absolutely cratering, but we clearly see all of the symptoms where it should slow down. And in that environment, technology typically does not perform that well, but it is right now. And so, I think it's important to kind of point out the sources of some of this more recent activity in the market. With this slide, we see here the NASDAQ 100. We have the price to earnings ratio. We can see that very clearly in the blue line here, having moved up from its lows that were realized at the end of last year, beginning of this year. So PE ratios, valuation has really moved higher as of late for these companies. And again, it's a very counter trend type of movement. When you're anticipating economic slowdown, you typically do not have margin expansion on technology, especially with higher interest rates. But what you've seen here in the amber line is that earnings estimates are beginning to move higher a little bit. So that's helping obviously to push prices higher, but we've also seen this multiple expansion, which is very odd at this point. Now, what we're looking at on a macro level, we've seen interest rates kind of roll off in the wake of Silicon Valley. The interest rate expectations for the terminal rate and peak rates for Fed funds, have come down a little bit. And so interest rate expectations have come down a little bit. And so that does provide some feedstock into like some multiple expansion. But what we're seeing right now in technology is very odd for this point in the cycle. Now, having said all of that, we have a chart here from Carson Investment Research, which indicates that when you have a quarter like we just completed, the markets were up, they were positive, and regardless of where the source of that gain came from. Now, again, we readily acknowledge that it was a very narrow leadership in this market from technology, as we just saw in the prior two charts. So, but despite that, when you have a quarter like we just ended, you almost always end the year up, and you typically have a relatively good year. Again, this would fly completely in the face of the fact that we may be sitting at the front end of a recession later this year. Again, there's a lot of things that we don't know yet, but just looking at it strictly from the numbers, as we go back here to 1954, when you have a quarter as strong as we did, even though it was technology led, in many cases it was junk led, that you tend to have up years thereafter. And here we have a plot here during the month of March of some of the various areas of the market. And in that green line, you see that's leading the way again is the QQQ, which is the technology. It's the NASDAQ 100. Now we have a plot here of the Fed funds target rate up against the chained index for economic growth for GDP. You can see the GDP in the amber line. You can see the Fed funds target rate in the blue. You can see the 9 rounds of rate increases that we've had thus far in the tightening cycle. Again, a lot of speculation that we're closer to the end of that tightening cycle, and I think that's probably a fair assessment. Although I think the one takeaway that I have from all of that conversation is that the market is clearly expecting these rates to come down later this year by perhaps even 2 percentage points, and I just don't see that happening unless there's a major calamity in the economy. But you can see that down below in that chained index there that the latest reading for annualized GDP was 2.7%. Again, not terrible. I think it may be the high mark for economic growth for a couple of quarters here. Do not anticipate fairly strong growth, but as you'll see in the next slide, those estimates are actually coming up. And so this is giving some new life to stock markets. It's giving new life in some of these more speculative kind of risk on trades, if you will. But clearly, I think the conventional wisdom says that we're going to have more slowing here in response to the liquidity being cut off in many parts of the economy. But I did want to show the relationship here between these two. And here's that chart that I mentioned before. It is the growth forecast for 2023. You can see that that's now 1%. And so if you assume that we start the year with something north of 2, then that would suggest that then to offset that, that you're going to have some slow growth and perhaps some contraction even. I think that's absolutely in the cards now. I don't think anybody is predicting a deep recession or a deep contraction, but again, the estimates as we entered the year were pretty bleak. We were looking at fourth quarter growth that, like I said, has wound up around 2.7% ish, and then that we're going to result in in an annual growth rate that was just barely above naught. But now we can see that those estimates are moving a little bit higher, although they're still fairly tepid. Here's a Conference Board survey of jobs plentiful. This is a survey that asks people, are jobs plentiful to fill in your industry? And that index is still pretty high. So what that tells us is that the labor market continues to be strong in a lot of areas. Here's a Fed survey of consumer expectations, and this is 1 year ahead inflation expectations plotted against 3 year ahead inflation expectations, and the 1 year is in that light blue, and the 3 years in the darker shade, and you can see how both of these have come down over many months, and so we've got the lowest readings that we've seen really in a couple of years now. You look at the 3 year ahead, it's 2.66%. The 1 year ahead is 4.23. So again, we have a little ways to go, and we are making progress on the inflation front. And but at least from an expectation standpoint, this is what helps to set interest rate levels, and you can see that these are moderating quite a bit right now. A couple of notes on inflation here. So what's really interesting is, chicken prices. You look at beef and chicken. Chicken prices in February were down 50%, almost 51% versus last year. Meanwhile, we've got orange juice that's up 81%. And then we talked a lot about eggs and other types of food commodity prices that are in various states of flux. So again, I don't think it's necessarily uniform how these things are moving around, but there are puts and takes clearly in the market right now. Here's a tweet from Jeffrey Kleintop at Schwab that I thought was really interesting. And so, we saw, in the last couple of slides, at least a little bit more optimism with regard to economic growth, and how that's kind of filtering in some of these confidence levels and some of these risk-on trades. But one thing that is actually pretty ironic right here is the price, the demand for corrugated boxes. And think about Amazon. These are all corrugated boxes to ship stuff around. And you can see that the demand plunged to 2020 recession lows. And, if that's not a clear indication of some form of economic contraction, I don't know what is. Getting back to banking here for a second, here's a chart that shows you the KBW Bank Index in the blue on the upper side part of this chart against the 2-year Treasury, which is in the amber line. And you can see how these don't necessarily move together quite a bit, but the correlation between the two, which is historically positive, has been extraordinarily positive, where you've seen, rates move in tandem with the bank index. And again, that's historically positive, and the below line shows you where they've not been positive, and those are the red areas. And we've had a lot of inverse correlation in this ratio for the better part of the last year, but just lately, though, in the wake of Silicon Valley, it's turned quite positive. This is a chart that shows you the plot of the dollar index relative to the ratio of domestic sales to international sales. And so you see here in the amber line, the dollar has moved a little bit lower for the year. And it continues its decline that really started last fall. And then against that line, you see the ratio of domestic sales versus international sales. So as the dollar has dropped, international sales have picked up because the dollar is cheaper, and that means goods that are being exported from the U.S. are a little bit cheaper. And so you see that companies that have more international exposure have actually done a little bit better as of late. So clearly, in response to that, we've kind of migrated some of our investment back into the international space because we see the earnings picture beginning to pick up, and we've got some charts on the international space coming up. Here's a chart of the relationship of the global money supply versus the S&P 500. S&P is in the amber line. Global money supply is defined by global M2 is in the blue line. And you can see that money supply has moved up in response to some of the challenges in the economy. Again, this is a global number, not just U.S., but the stock market index, which has been kind of treading water to some degree. If you look at it over maybe the last year or so, hugging the 4,000 index level. This has a pretty strong correlation. You can see there in the red, it's about 93%. That's a pretty strong relationship. So to the extent that global money supply, continues to move higher, which I don't think it necessarily will. It may be plateauing here or maybe a little bit range bound. We've got some, obviously some banking issues that are requiring more liquidity into the market. So you may see that spike up a little bit near term, but I think overall pulling money out of the system to try to engineer kind of a soft landing around the globe is really the, what's on the recipe right now. So if that's the case with this tight correlation, I think it doesn't necessarily bode as well for stocks for continued growth. But again, it's worthwhile to look at this ratio. And here's a change in U.S. liquidity versus the index. And this also has a pretty strong correlation at roughly 90%. And so you can see that in that blue line, you see that most recent bump. Well, that's the liquidity that's been required to kind of like, salve the wound, so to speak, of Silicon Valley, Signature et al. You can see that move higher. And so that may have some explanatory power behind why the equity market is kind of meandered higher, because we've got more liquidity. But I think it's a relatively short-term phenomenon, and then we begin to roll over and then contract that liquidity, because that's clearly what the Fed's trying to do. So again, with a high correlation of these two, if that liquidity begins to taper off and then turn negative again, then I think, we'll see a little bit more volatility in the equity markets. Now, kind of taking a step back and looking at commodities in general, this is one thing that really intrigued me when I came across this, is that, S&P commodity, the S&P commodity index and just commodities in general relative to the S&P 500 are as cheap as they've been in a very long time. If you think about what happened with the Ukraine invasion by Russia, we have a spike in wheat, grains, oil, a lot of energy, and then that's really kind of reversed. And it's almost kind of odd how we're seeing in Europe some of the data that they've clearly been able to navigate. Now, some of it has to do with weather being favorable. But clearly, you look at the S&P commodity basket relative to the S&P 500, and this is a chart that would inspire you to want to own commodities in this environment. We'll talk about mortgages in the housing sector for just a brief bit. Now, here's the 30-year mortgage minus the 10-year U.S. Treasury, and it's very odd to see that ratio be as high as it is now. So just think about that. The 30-year mortgage rate is extraordinarily high relative to where Treasuries, the 10-year Treasury is right now, and you can see that very clearly in the right hand of this chart. This is a little dated, but it's still relevant, at least directionally. It's still very, very high. The spread as of the date of this particular chart was about 386 basis points, or about 3.86%. And that's very, very, very high. This is the same data that we saw in the prior chart. It just takes us back a little bit further, back to the early 1970s. And so when you draw that historical average, it just makes the current environment stand out much, much greater. A chart that I think has some reasonable predictive power in it. And so this is a plot in the blue of mortgage activity. And you can see that that's clearly gone down. We've known that for a while. Interest rates moving higher has taken a lot of teeth out of demand. And then you see the Case-Shiller National Home Price Index in the white line there. And so that's been moving down too. Now we have on that line, on that particular line, we lagged that by a year. And so what this chart here tells us is, with this massive drop, even though mortgage activity has picked up a little bit lately with interest rates having come down a little bit, we're still down about 61, 62% from a year ago. And so what this chart tells you, and the correlation of these two data series, what it tells us is that we expect home prices to continue to fall a little bit further. So here's a Federal Reserve Bank of Atlanta Housing Affordability Index, and by their measure, affordability is worse now than it was in 2008. So you think about, regardless of kind of this near-term movement in interest rates, that housing, by and large, for the home buyer, for the new home buyer, and even those folks that would be interested in moving, it creates a real hard environment for them right now. Case-Shiller Home Price Index, going back and looking at kind of half-decade segments, if you will, and you can see that this kind of slow, methodical rise up through the global financial crisis, and how it really took several years to kind of get back on a growth track. So even though the financial crisis was 2008, in the beginning of 2009, it really wasn't until like 2011, 12, where we began to see, these prices move up again. And so we had this decade of underbuilding because the economics weren't that great for several years. And so we've been trying to catch up. And then obviously with low interest rates and very easy credit, there was a lot of mobility and a lot of demand for housing. It was a seller's market, and that has obviously changed. And Just to be clear, back in the global financial crisis, I mean, we had a rather dramatic 20 at its trough there. You can see there in the below, a 26% price contraction on the average, on this index after the global financial crisis. And it was honestly in, 2011, 2012, where this thing really kind of worked itself out. And right now we're sitting at about -3%. So again, if you think about the chart that I showed you before, with that correlation between mortgage activity, that things are apt to slow down a little bit from here, even still. Here's the Case-Shiller National Home Price Index, um, and you can see that that is rolling over. The office market, and we're showing a little bit of an increase here in vacancy levels. Not too surprising, considering this continuing evolution of the future of office, if you will. But I think in the current environment, and maybe where we're heading with regard to economic growth or the lack of growth, maybe looking into the next several quarters, is that the commercial real estate market may be a little bit challenged. But there's certainly some bargains out there. Now we'll look at Europe on a couple of charts here. We've got baseload electricity futures price. This is basically electricity costs in Europe are back below pre-invasion levels. So if you can think about that for just a second and how odd that is considering all of these energy choke points and sources for baseload power in Europe, how this could actually be the case, but it is. And partially as a result of that, you see the recession expectations have really gone down in Europe. In fact, the probability of recession is now lower in Europe than it is here in the US. Well, sometimes a picture is worth 1,000 words, and this is a chart that definitely fits that bill. Chart that data series goes back to the founding of our country, and you can read that caption at the bottom that we talk a lot about how debt has skyrocketed lately. When we have these pandemics or when we have the global financial crisis, but you can look at kind of the modern era, if you will. If you look back over the last 2 to 3 generations and how amazing this trajectory has looked, and just the shock value of looking at this and saying, from George Washington to George Bush, that we added $7 trillion of total federal debt, and that since March of 2000, since the economic shutdown due to the pandemic, that we've added another $7 trillion to our outstanding debt. And this is the legacy, unfortunately, that we're leaving for future generations to either find a way to slow this growth or turn this south again. Chart we're looking at right now is U.S. rents versus shelter as a component of the consumer price index and the year-over-year change there. And so the shelter CPI you see here in the amber line, and rents defined by apartment rents you can see here in the blue line. And what's interesting about this is several things actually. Shelter as a component of the consumer price index is very meaningful. It's about a third, and it's even more so if you look at the core CPI index. And so, rents tend to lead shelter CPI by a number of months. And so when you think about the shelter CPI component continuing to move higher here, and how it influences overall consumer price inflation, which we all know that we're trying to bring down, it is very helpful to know that we're seeing deceleration in rents right now. They're still high, maybe still moving at a higher clip than what we're used to, but they are decelerating. And so eventually that's going to feed into the shelter component of CPI, which in turn will help to drive inflation lower, which is what we all want. So I think there's a natural bridge here being built to lower inflation by virtue of these rents coming down. Well, on our last couple of charts, we'll focus on China here. One thing that has intrigued me quite a bit is this whole relationship between the Chinese being a strategic owner of U.S. Treasury debt and these geopolitical tensions that we have with China, and the fact that we're very much in a kind of a new Cold War with China. And as you can see here, clearly the Chinese have been reducing their holdings of U.S. Treasury debt. Now, between China and Japan, two very important owners of this debt. And so the risk is the Chinese say, all right, well, we're going to flood the market, we're going to sell, and we'll drive prices lower and yields higher for U.S. Treasury debt and make it and really dislocate the market. Well, one, that would be extremely disingenuous to China's own financial condition. And you can see here too that there have been a lot of buyers that have kind of offset the decline in Chinese ownership. You can see that UK, Belgium, Luxembourg, even Canada has stepped up its acquisition program of US Treasuries. And you can see that that's helped to offset. And so the net financial impact as we continue to move forward and the Chinese continue to reduce their holdings of US debt should be entirely positive for us. And here's a chart that shows here the crude imports as a percent of the total for China. And obviously they're relying very heavily on this relationship with Russia, a very tenuous relationship, I should probably add. And you can see here that the imports from Saudi Arabia have picked up. The Russian imports have been increasing for quite some time, but it is notable here that we see the Saudis with perhaps kind of a less strong relationship with the U.S. right now in the wake of the Khashoggi debacle. That perhaps the relations with the U.S. aren't nearly as good as they were. So you see the Saudis shipping more oil to China. That's all we have for today. Hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon.